Okay, let's unpack this. Today, we're taking a deep dive into the latest financial disclosures from Kraft Ltd. They're a major player in the Indian home and kitchen appliance market. We've got quite a stack of fascinating sources here. Their official investor releases, the detailed financial results, and even the investor presentation they're using for their upcoming conference call. Our mission, really, is to cut through the numbers, the technical jargon, to extract the most important nuggets of knowledge, insight, and help you understand what's really happening with this company. So what does this all mean for you, the consumer, and what does it tell us about, the broader market trends in India?
Exactly. And what's truly fascinating here is that we'll be able to see not just the what of their Q1 FY26 performance, but also the why it matters, connecting these specific results to the bigger picture.
Hmm.
The Indian economy, evolving consumer shifts. This deep dive should offer some real aha moments, give you a comprehensive understanding without drowning you in data.
Right, let's start with those headline numbers then. Stovecraft's first quarter of fiscal year 2026 ending June 30, 2025. Their total revenues clocked in at 340.1 crores. And just for context, a crore is 10 million rupees. So that's about 3.4 billion Indian rupees. Or for our international listeners, roughly 40 million US dollars. How does that revenue figure compare year on year, quarter on quarter?
Well, from the sources, we see revenue grew by a solid 8.2% compared to Q1 of the previous fiscal year, FY25, and an even stronger 8.7% compared to the immediately preceding quarter, Q4 FY25.
Hmm.
So this growth, especially that accelerated quarter-on-quarter momentum, it suggests Stovecraft isn't just riding general economic tailwinds, but seems to be actively expanding its reach and capturing more market share.
Okay. And beyond the top line revenue, profit figures often tell a deeper story, right? About a company's health. What are we seeing there? Particularly with net profit?
Indeed. Gross profit reached 130.4 crores. That's up 8.5% year on year. Their gross profit percentage stayed stable and pretty healthy, above 38%, specifically 38.3% for this quarter, Q1 FY26, just slightly up from 38.2% last year. And it aligns well with their full year target, which is around 39%,
Okay.
and EBITDA, that's earnings before interest, taxes, depreciation, and amortization, basically a key measure of core operating profitability. That also saw a healthy increase, 12.5% year on year, reaching 35.6 crores, and the EBITDA margin actually expanded to 10.5%.
The real standout number here, it seems, is the profit after tax. Sources show a phenomenal jump.
Absolutely. Pay came in at 10.4 crores. That marks a 27.2% increase year on year, which is strong. But if we zoom out a bit to the bigger picture, the quarter-on-quarter growth is, well, it's striking. A massive 620.5% compared to Q4 FY25.
Wow, 620%.
Yeah. Management attributes this to enhanced operational leverage and cost efficiency, and they expect further margin expansion. This certainly raises a question, though. What contributed to such a substantial increase from just the previous quarter?
That's a critical question. And the detailed financial notes, they do give us a specific answer, don't they? It seems there were some accounting adjustments that significantly impacted depreciation.
That's right. A keen observation. The company rationalized its depreciation because of changes in estimates. So this resulted in a one-time gain, about INR 15.71 million, from reassessing lease terms. Essentially, some leases turned out less costly than projected, giving them a bit of a profit boost.
Okay.
But on the flip side, there was also additional depreciation of INR 9.56 million. This was due to revised useful lives of leasehold improvements, meaning some assets were expected to wear out faster.
Right.
So these accounting decisions, even if they're routine, they can definitely influence reported quarterly profits, though the company states it's all in line with their business plan and, standard accounting practices.
Got it. And wrapping up the financials, what about earnings per share, EPS, and the company's efficiency ratios?
Okay, so basic and diluted EPS for Q1 FY26 stood at 3.15, and the return ratios, they're also recovering, which is a positive sign for efficiency. ROCE, that's return on capital employed, is at 15.0%, and ROE, return on equity, is at 8.7% for the quarter.
And those are important because?
Well, ROCE tells us how effectively the company is using all its capital, debt, and equity to generate profits, while ROE specifically measures the profit generated for each rupee of shareholders' equity. Their recovery indicates, improved efficiency in using their capital to create value.
Okay, so we've seen the impressive numbers, but how did Stovecraft achieve this? What were their key strategic plays in Q1? Let's dive into their product performance first. Which categories are really driving growth? Any surprises in the mix?
Right. Looking at the product categories, induction cooktops saw really strong growth, 18.4% in value, 10.1% in volume year on year. Small appliances also did well, 18.2% value growth, although volume saw a slight dip there, about 4.4%.
Hmm.
What's particularly interesting, maybe a sign of shifting consumer behavior, is nonstick cookware. It saw 10.7% value growth, but its volume declined by 21.3%.
Oh, interesting. Volume down, value up.
Exactly. And gas cooktops, they saw a decrease in both value and volume.
So what does this tell you about their product mix? Is this a risk or more like a strategic evolution?
Well, it really highlights, I think, a fundamental shift in consumer preferences. The decline in volume for gas cooktops and even nonstick cookware despite value growth. It suggests a move away from maybe traditional staples towards more modern, potentially higher value appliances like induction cooktops.
Right, people upgrading.
Possibly. Or just buying differently. It implies consumers might be more willing now to invest in premium or more specialized items. Now, pressure cookers, small appliances, and induction cooktops make up the bulk of their revenue. And the sources say cooktops, chimneys, and hobs contribute 49% of total revenue.
Well, it's a strong core.
A strong core business, yes. But crucially, also strategic diversification. They seem to be capitalizing on these emerging higher value categories like induction cooktops and other new appliance segments.
Makes sense. And the company's focus on retail expansion is also really clear from the sources. Tell us about their physical footprint across India.
Yeah, they're actively expanding their exclusive retail channel, added 19 new stores in Q1 alone. That brings their total to 281 operational stores. And
Wow.
that's across 19 states and 110 cities in India now.
Wow, quite the spread.
It is. And they're particularly focused on accelerating expansion in northern and western India. This isn't just about, having more stores. It feels like a strategic move to reduce regional concentration, tap into new growth pockets, diversify sales channels, and really enhance that brand presence nationwide.
Okay. And what stands out to you about how these growing number of stores are actually performing? Are they seeing good engagement?
Well, the average sale per store is reported at a healthy 3.6 lakhs per month. That's 360,000 rupees.
Pretty decent.
It is. And that figure, combined with adding over 114,000 new customers and a solid 18% repeat purchase rate, it suggests robust consumer engagement, consistent demand across their growing network.
Yeah, that 18% repeat rate is significant. Shows loyalty.
Absolutely. It indicates customer satisfaction, which
Yeah.
is crucial for, long-term sustainable growth.
So beyond expanding physical stores, what about new products, brand initiatives? Anything catch your eye?
Definitely. The company is aggressively pushing innovation and something called backward integration.
Okay, explain that a bit.
So they've started in-house manufacturing of chimneys. They see that as a high-potential, under-penetrated segment. And backward integration just means they're taking control of more steps in their supply chain, manufacturing components or whole products themselves instead of just buying from external suppliers.
Okay, control costs, quality.
Exactly. It can lead to better quality control, cost savings, improved margins, which we are seeing signs of here. They've also increased production of backward integrated kettles and cast iron cookware. That's directly supported their margin gains, according to the reports. And development's also underway for outdoor cooking products and bakeware, specifically targeting export demand. So it shows a real commitment to vertical integration and responding to diverse market opportunities, both domestic and international.
And there was a unique campaign too, right? Caught my attention.
Yes, they initiated the...
All right, now let's shift gears a bit. Companies' operational health, navigating the broader economy. The sources mention inventory levels. How's Stovecraft managing this, especially with seasonal demand?
Okay, inventory days were higher, 149 days for Q1 FY26. But the company explicitly states this inventory is being built up to meet upcoming festival demand.
Preparing for Diwali and other festivals?
Precisely. Net working capital days stood at 75 for Q1. They expect improvement in July and August after export orders are dispatched and the festive season really kicks in. It highlights how critical this inventory management is, right, for capitalizing on that seasonal consumer spending.
Yeah, it's a balancing act.
It is. Higher inventory ties up capital, sure. But for a consumer durables company, strategically building stock before major festivals.
Yeah.
It's a calculated move. Ensures products are there when demand peaks, maximizing sales.
Makes sense. Their debt position seems quite stable, which is always a good sign for financial health.
Yes, the debt-equity ratio is reported as stable at 0.49, or 0.43 if you exclude lease liabilities. So that suggests a pretty healthy financial structure. Indicates they're not overly reliant on debt to finance operations. Provides a good buffer.
What's also interesting here, the mention of employee stock options, ESOPs, a way to align incentives.
Indeed. The board approved granting 18,162 stock options to eligible employees under their ESOP plan in 2018. The exercise price is set at 578.1 reoption per option, and the vesting period is staggered over 4 years, with increasing percentages vesting each year.
Standard practice, but good to see.
Yeah, it's a common and usually effective mechanism for aligning employee incentives with the company's long-term performance and success. As of June 30th, 2025, there were almost 130,000 outstanding options. So it shows a significant portion of the workforce is kind of tied to the company's growth.
Okay. And looking at the bigger economic picture, Stovecraft seems to be operating with some significant tailwinds in India. What are these broader market trends that are favoring them?
Absolutely. The investor presentation highlights several key growth drivers. India's whole consumer durables market is expected to grow at roughly 11% compound annual growth rate, CAGR, until FY29. That's substantial.
Huge potential.
Yeah, and retail inflation, measured by the CPI, has improved. It's down to a much more manageable 2.1% in June 2025. That's a very positive sign for consumer spending. People's purchasing power isn't being eroded as quickly.
Good point.
Moreover, Tier 2 and Tier 3 cities are emerging as significant growth centers, reflecting rising demand for modern amenities, appliances, as prosperity spreads beyond the biggest metros.
Right, the next wave of growth. What about government influence? Any policies actively benefiting Stovecraft?
Yes, several government initiatives are creating a more favorable environment, things like energy labeling, BIS certification, that's the Bureau of Indian Standards, and enhanced safety standards. They're gradually phasing out substandard, non-branded products from the market.
Which helps the organized players.
Disproportionately benefits them, exactly, like Stovecraft, who focus on quality and standards. Furthermore, you've got GST, which streamlined taxes, the Make in India initiative supporting domestic manufacturing, and crucially, the Pradhan Mantri Ujjwala Yojana. That's the program providing LPG connections to underprivileged women. It indirectly boosts demand for efficient cooking appliances.
Ah, interesting link there.
Yeah. So this whole environment creates a very conducive space for continued growth for companies like Stovecraft.
And their export business is also contributing positively. Good diversification.
Right. Despite recent, geopolitical and trade disruptions we've seen globally, exports grew by a healthy 14% year-on-year in Q1 FY26. And exports now contribute a significant 20% to their total revenues.
20%, wow.
Yeah. So that diversification across international markets helps mitigate risks, associated with relying on just one market and lets them leverage broader global opportunities too.
Okay. Now, the sources also include some specific disclosures that might catch a curious learner's eye. Points towards transparency. For instance, the auditor's report mentions previous income tax search operations.
Yes, and this is a crucial point for transparency and understanding potential risks. The Income Tax Department carried out search operations at the company's premises back in November 2023.
Okay.
Stovecraft has since received notices, orders for various assessment years. They've responded or filed appeals. Importantly, management believes these operations are not likely to have any material adverse impact on the company's financial position or results.
And the auditors.
The statutory auditors, Pricewaterhouse Chartered Accountants LLP, they drew attention to this in their review report. But, and this is key, they did not modify their conclusion. Meaning, while they noted the issue for full disclosure, they essentially concur with management's assessment that it won't materially affect the financials. It's a really key part of financial disclosure, right? Providing you, the listener, with a full picture of potential risks, even if they're deemed non-material.
Right, transparency is key. So after diving deep into the numbers, the strategies, the operational environment, what does this all mean for Stovecraft's overall position, their future trajectory?
Well, if we connect all these pieces, Stovecraft is very clearly positioning itself as a comprehensive kitchen and home solutions provider. Not just stoves anymore, they have a long history. Flagship brands Pigeon and Gilma have over 16 years of market presence, high brand recall.
Familiar names.
Exactly. And they're actively moving into premium segments too with the Black plus Decker brand license. Their strong backward integrated manufacturing facilities in Bengaluru and Badi, plus an in-house R&D facility. That all provides a solid foundation for innovation, quality control, cost efficiency.
And management seems confident.
Management's consistent message, yeah, is one of expecting further margin expansion as operational leverage continues to build. Meaning, basically, as sales grow, profits should grow even faster because of their efficient cost structure.
Yeah.
So, the combined focus on expanding retail, diversifying products to meet evolving tastes, and leveraging those favorable macro trends in India, it paints a picture of a company actively pursuing sustainable, profitable growth.
Well, what a deep dive that was. We've seen how Kraft Ltd. Delivered a robust Q1 FY26 performance, marked by strong revenue, impressive PPET growth, driven by strategic retail expansion, diversified products, better operational efficiency.
Yeah, it's a clear illustration, isn't it? A company leveraging those favorable economic tailwinds in India, adapting its products to what consumers want now, and carefully managing its financial health for efficiency. For you, the learner, this deep dive hopefully offers a concise yet thorough understanding of how a major player in the Indian home appliance market is navigating growth, challenges, maybe even providing a template for how you can analyze other companies in similar sectors.
Absolutely. And so here's a provocative thought for you to mull over as we wrap up. Considering the rapid growth, the rising aspirations of consumers in those Tier 2 and Tier 3 cities in India, how might companies like Kraft continue to adapt their product offerings, marketing, distribution networks, maybe even pricing? How do they capture the evolving demands of these emerging consumer segments over the next few years, especially as competition, likely intensifies?